guys, Dave Keller here with StockCharts.com, and welcome to this special all mailbag edition of The Final Bar. It's Friday, July 19th. Hope you guys are all doing well. We're traveling around New England here, going into the weekend. Should be back and better than ever in Redmond, Washington for Monday's show. So I hope you guys all have a great weekend. And let's get right to question number one. By the way, questions coming in from you guys are always welcome. Email is best, thefinalbar@stockcharts.com. You can also tag us on X at FinalBarSCTV, or just put a comment below the video on YouTube, and we'll gather all those questions. Hope to answer one of yours in our next mailbag episode. All right, let's get to question number one. Dave, what is the optimum period of time for viewing a chart? 3 months, 6 months, 1 year, whatever? So whatever is definitely not the answer. Let's start there, right? I think you want to be intentional, and I think you're getting to that, right? You want to be intentional about and thoughtful about what time period you're doing. And I often find with new people, new technical analysis users, they often have a bit of a mismatch between their investment goals and their technical approach, right? So you say you're a long-term investor, but you're looking at a lot of short-term charts like hourly charts, or you're a swing trader and you're looking at charts that really aren't helping you understand that time frame very well. You're looking at way too much data. The general rule of thumb that I tend to go with, and this is a loose starting point, if you have no idea where you want to go, I always think whatever time from your investment horizon, go about 6 or 7 times that much data before the moment you're looking at, right? So if my average holding period or my investment horizon is about 1 month, I would say go out to 6 to 9 months or so as a starting point, and then you kind of tweak it from there. If you find you're often struggling because you need more context, then you make it a 1-year chart or a 2-year chart. Or if you find that that's way too much data and all you're doing is looking at the most recent data, you don't really care about the rest of it, start making it a 3-month chart or a 1-month chart, right? You have to start with a point. And so I usually give people the idea of about 6 or 7 times your investment horizon. That may be a good starting point to the amount of data you want to bring in on your charts. Now, if you have no idea what I'm talking about, I would start with our default charts. If I remember right, I think our default chart is a 1-year chart. It might be a 6-month chart. Either one of those, I think, is a decent place to start. When I started using technical analysis, I was working with a lot of hedge fund managers, a lot of trading desks. So I would start with a 6-month daily chart, and that was about as long of a time frame as I would bring in. And then I would get into hourly charts and 5-minute charts and often 1-minute charts on like S&P futures to really understand short-term dynamics. As I started working with longer-term investors at Fidelity and more money managers thinking about multiple cycles, I started with a 1-year daily chart. And as you've probably seen if you've watched this show for any period of time, my default chart is now a 2-year daily chart, and I often combine that with a 7-year weekly chart, because now I'm thinking much more long term as a time frame. I'm thinking bigger picture and more secular as opposed to tactical trends in my own investment process. So I've adapted my charting routine to match that. And it's not to say that anyone is wrong. What's wrong is using a chart setup that is a mismatch to your investment horizon. So I would say, as with many things with investing, the first question to ask is, what are your investment goals? Right? What are you trying to accomplish? And particularly, what's your investment horizon? About how far out are you tending to look with an investment? Start there, go about 6 to 7 times. That would be my starting point, and then tweak it from there, make it longer or shorter if you're finding you need more or less context, more or less data to make effective decisions in your portfolio. Great question. Next one. I enjoyed your recent presentation using sector relative charts, sectors versus the SPY. I do something similar using Vanguard ETFs, and I rotate into the strongest 10 or so. Your thoughts? Well, my initial thought is I love this approach, and very selfishly, and with my own, I have a biased opinion on this because it's very similar to what I do in my own investing, my own portfolio. I use what Gaddis Rose would call a core and explore process, right? You have a core of your portfolio that is more momentum driven, more systematic, and then you have an exploratory, a smaller opportunistic portion of your portfolio, which allows you to manage much more actively and bet on individual names and ideas that you want to add exposure to. I like that balance of having the consistency and the stability of a core position and the ability to, express my investment thesis in my portfolio when I would need. And so that balance has worked very well for me. So with the core part of my portfolio, I use a variation, to be honest with you, of the model that you're using. This is a screenshot, by the way, that you sent me, using a chart list on StockCharts. And I think the way that you're using this chart list feature within StockCharts to do this, I think is spot on. What you had mentioned in your question is that you sort these by RSI. And so you have the Vanguard group of ETFs, which sounds like your investment universe. You're sorting it in descending order by RSI, and then with some consistency, you rotate into the strongest names. Now, this is a tried and true approach. Some would call this like the Ivy portfolio. There are a couple different people that have written really good books on this. If you go to my recommended reading list, which is at marketmisbehavior.com, and then click on reading list in the upper right, there are a couple books on there that I think will help you. If you're not familiar with this approach, to help you make sense of it, Gary Antonacci's Dual Momentum Investing is probably where I would start. Wes Gray and Jack Vogel wrote a book called Value Momentum or something like that. I'm so sorry, Wes and Jack, that I forget the name, because you wrote a couple books that have similar names. But that talks about a momentum model, different approach, but very similar. And then Meb Faber wrote about the Ivy portfolio. And it's the same idea, right? You're just kind of wrote to a momentum strategy where you continue to rebalance. And so I would say a couple comments. Number one, the key to this sort of approach is consistency. So I rebalance my core positions at the end of last trading day of every month. Doing it sporadically is not going to get it done. You really want to have a consistent approach to that. So I would encourage you to do that. And it doesn't have to be as often as you think. I do it monthly. The second thing is RSI is a good starting point. The scooter ranking is another one that comes to mind that could be an interesting one to use because it's a more robust model that combines RSI along with other indicators, has some different timeframes on there. Sometimes just pure performance, right? And just looking at performance over the last 6 to 12 months or some combination of those can give you a good idea. There are a number of different ways to measure momentum, but that general approach of having a group of, and I would say the third comment is be thoughtful about the things that you put in there, right? So you're putting the Vanguard funds. I actually use a different group of funds that I use with my broker. Refining and evolving that group of funds as needed, I think, is important too, and being thoughtful about what things are in there. A lot of times I'll see people do a momentum model, and then they'll have a bunch of ETFs that are very, very similar. For example, right, you have the Vanguard Russell 1000 Growth, the Vanguard Growth, the Vanguard S&P 500 Growth. Those are all super similar ETFs. I mean, the correlation between those three is going to be very, very high. So remembering that, having different choices that are actually different is going to make that momentum model more meaningful. Otherwise, you're just rotating into a bunch of growth and you're kind of doing the same thing all around. But overall, I would say the idea of this makes a ton of sense. And if you want to learn more about that kind of sort of momentum approach for a core position, go to marketmisbehavior.com, click on reading lists in the upper right. There's some books that I think could help you fill in the details on that. But thumbs up in terms of how you're approaching things. I like it. Next question. A while back, you mentioned the Hindenburg Omen indicator. Does that stay in effect, and for how long? Thanks so much for asking about this. And the answer is it does to a certain degree. I'm going to bring up my breadth chart list. And by the way, if you are a StockCharts member, which you all should be, and if you're not, by the way, if you go to StockCharts.com and sign up for a new account, use the code Keller10, Keller, the number 10, Keller10. You can get 10% off your new account. So I'd encourage you to check it out if you've not before. And I don't get anything from that, by the way. It's just a code I can share with you that'll give you a good deal. So please enjoy and check it out. But those of you that are members, if you go to your dashboard and you go down to your chart lists and you go to the bottom, there's this gray little button that says Manage Chart Packs. And there's a free chart pack that I provide called David Keller's Morning Coffee Routine. You are more than welcome to check that out. It's free for members, and it includes this breadth chart list that I'm accessing right now, along with chart lists on sentiment, global ETFs, and a bunch of other things that I actually review pretty much every trading day. So I would encourage you to check that out. I have this chart called Hindenburg Omen components, and I've talked about this, randomly here. So just as a quick refresher, the Hindenburg Omen is a market model. It's similar to like the Kappa curve and other things that don't signal very often, but when they do, it tends to be important. The idea with the Hindenburg Omen is it's something that is meant to identify market tops, and it was created by a strategist who researched a bunch of previous market tops and tried to find consistent patterns, settled in on these three basic criteria, which is how we've applied it on the StockCharts platform. You need the market in an uptrend, so you need the New York Stock Exchange Composite Index to be positive over the last 50 days. You need a significant number of new 52-week highs and new 52-week lows on the same day, because he found at major market tops there would be a big indecision and things would be going up and down at the same point. And then breadth has to turn negative, which is the McClellan oscillator going below zero. Now that has happened a couple times so far in 2024, but a key part of the confirmed Hindenburg Omen is you need multiple signals within 1 month, which is about 20 trading days. So we did get an initial signal, which is what I call it, in early February, but we never got that confirmation, so it's not a valid signal. We got another signal in the end of May. We had about a 1 month period to wait for a confirmation. We didn't get it. It took about 6 weeks, which is beyond the cutoff for an initial signal. We did get another signal just last week. And so I think that's another initial signal, which means you got a couple more weeks to see if the Hindenburg Omen triggers by using multiple signals. And if you look back to the left, you'll see the last two signals that we got that were confirmed, multiple signals within 1 month of each other, were in the at the end of 2021 and just before the COVID, just at the COVID peak. So it has been, I mean, if you look at major market tops, it has almost always been in Hindenburg Omen. It will give false signals, right? Meaning, as people will say, it's predicted 10 out of the last 5 corrections, right? So I mean, it'll over signal, but again, I've learned to be wary and look for signs of a breakdown and expect a likely downside scenario if we do get a confirmed signal. So that's the idea. It's about a 1 month cutoff, and different indicators like this have different cutoffs. They're all very unique depending on the creator and how they tested it and developed it. I would say that make sure you download that chart pack, and this one, along with a bunch of other cool charts, are included there, and you're welcome to it as a StockCharts member. Next question. There are 105 Dow Jones Groups on the StockCharts website. Can you explain how stocks are indexed within their groups? Really interesting question. I will tell you, if you really want to frustrate yourself as a market investment professional, spend a bunch of time trying to go through indexes and weightings and structure. And I will tell you, this comes from my days working at a large money manager, because our job was to outperform a benchmark. So you spent a ton of time dissecting your benchmark in detail because you wanted to know what the big weights were, where the opportunities were, how much of your portfolio was in your benchmark versus outside your benchmark, which is a measure called active share. We would go through all of those metrics just to try to find anything we could do to outperform the S&P 500 or the Russell 2000 value or whatever benchmark that a particular fund was being compared to. And so you spend a lot of time with it. And the reality is, indexes are pretty much all over the place, right? So the people at Dow Jones or Standard & Poor's or Russell or wherever use whatever process they want to create these indexes. They will give you their methodology, but they will not ever show you behind the scenes, here's what we actually did. And they can add or subtract stocks from an index whenever they want to. That's part of their mandate, as they see it, is to make sure they're swapping in the right name. So the members of the S&P 500 change. It's not a static group of 500 companies, and we're looking at how that group does. The companies now are very different than the companies that were in the S&P 500 5, 10, 20, 40 years ago. 40 years ago is a totally different benchmark with different weights because things change, and they're adding and subtracting names because things happen. So the Dow, that was a long-winded way of saying it's not as, it's going to be frustrating, I'm afraid, when you look at it. The Dow industry groups, which I have on my dashboard, I have a chart list which includes these Dow industry groups, which I love reviewing because it's a starting point. And what I use it for is every day during the trading trading day, what's going up a lot, what's going down a lot. But the reality is, here's how these indexes are created. They are price-weighted indexes, which a lot of Dow indexes use. The Dow 30, the Dow Transports are price-weighted indexes, which means the larger the dollar price of the stock, the bigger the weight. Now, most indexes like the S&P 500, all of those sector ETFs, the NASDAQ 100 are cap-weighted indexes, meaning the bigger market cap means the bigger weight, and they're scaled by the market cap. Price weighting is sort of a controversial one. It's not particularly good, and I think it's an antiquated approach, comes from the days when, the dollar value of a stock, I think, meant a lot more in the, world of fractional ownership like we have in 2024. I don't think it's a super relevant metric, but it's still used. So the answer is it is a price-weighted index. In terms of which stocks are included, good luck finding that, because it's really hard unless you pay for some premium institutional product from Dow Jones. They would love to sell it to you for tons and tons of dollars every month. Probably inaccessible to most investors. And knowing how they're rotated is also difficult as well. So what we do on StockCharts is actually we have this feature. If you go to Charts and Tools and then go to this guy called Industry Summary, we actually have a proprietary method that our data team, along with me and Julius DeKempener, Grayson Rose, and other sort of market practitioners at the firm at StockCharts, we actually go through and hand select which Dow industry groups we think match into different sectors. So we actually determine where stocks are going to be bucketed. We actually determine which industry groups go with which sectors, which is why you may see differences between what a stock is labeled on StockCharts versus other platforms, because we're doing it how we think it makes sense. But bucketing stocks into a particular group is very, very difficult, to be honest with you. But my point of bringing that up is if you click on a group like asset managers, we will show you not necessarily which stocks are included in the Dow indexes, because we don't know that information, but we show you the names that we are labeling as those. So you can get a sense of which stocks are in there. In terms of the exact answer to your question, it's really hard to determine the weightings. And that's why I like to, use this as an indicative value, but really analyze the big names in each industry group and the individual charts to get a sense of how that group is really performing over time. Next question, is there a way to turn the daily scooter rankings into an indicator to track its relationship to price over a period of time? Awesome question, and I appreciate that so much. And your question makes me think of the late, great Greg Schnell, who sadly passed away earlier this year, as a longtime StockCharts contributor. He first turned me on to using the scooter rankings as an indicator. On the Sharp Charts platform or on ACP as well, we have a series of indicators. And if you go to the indicator section, you will find one called Scooter Line, SCTR line. And what that's going to do is add the scooter ranking as an indicator over time. Now, this is actually a really interesting metric because it helps you see how the relative performance or relative strength based on the trend of this particular stock has changed over time, right? We always report the current scooter ranking up in the quote line, which is what I often glance up there and just see what the rating is, because this gives you a sense it's in the 75th percentile right now versus all the other large cap stocks. One of the scans that Chip Anderson turned me on to a long time ago was looking for scooter rankings breaking above 70, because that means it's been not one of the strongest stocks, but then when it breaks above 70, it all of a sudden is becoming one of the strongest stocks. So I'm going to take this, draw just a horizontal line right at the 70 level, put it down here at the bottom so we can see it. All right, so that's where the scooter line is at 70. Look at what happens for Apple out of the 2023 low, sort of rallies. You can see we finally break above the 70 line in mid-March, chops around a little bit, really gets above there in May, and that's before this nice stretch of strength and outperformance. You can see here after this deterioration, we see the gap higher, finally breaks above a scooter ranking of 70 in early June, and that tells you, yep, we're in a period of strength. So, recognizing when stocks are breaking out of bases, I think a scooter ranking breaking above 70 is an interesting way to see that. But also just understanding the natural cycle of leadership and laggership and how certain stocks are starting to improve after not being one of the stronger names. And you're seeing it right now, to be honest with you. You're going to start to see it, I think, with a lot of value-oriented stocks, things like financials and energy and materials, which have not had particularly strong scooter rankings. all of a sudden starting to tick up a little bit because they're starting to work while mega cap growth like Apple and Nvidia are starting to struggle a little bit. So while I don't show them often on the show or in my work, I think it's an interesting way to think about relative performance over time in a little different way. That's it for our show today. Thanks so much, everyone, for joining us here on the Final Bar. Have a fantastic weekend, and I'll be back hopefully in Redmond, Washington, safely for Monday's show, and I look forward to bringing more thoughts on the market environment. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a great weekend.